Welcome to Investors Insights, episode number 146. Today we will be discussing the impact on your portfolio in relation to the possibilities. Will Russia go to war? Will Saudi Arabia continue to put pressure on oil prices? Will frackers in this country have to go bankrupt? From the standpoint of a bear market, are we there yet? As well as what other economic information may come about. There's a lot to discuss in this vlog, and you will find that we really like to hear from you. And if you like what we have to say, then take time out of your schedule to send us an email or give us a phone call. If you don't like what we have to say, we like to have those conversations as well, because in those dynamics is where we come up with a lot of facts, data, and the right answers. I encourage you to connect with us on Facebook, Twitter, and LinkedIn, and links are on our blog. So let's jump right in because we've already had a heated discussion this morning, and we're going to let you be a part of it.
I'm Greg Powell, and this is Investors Insights.
You're listening to Investors Insights with President and CEO Greg Powell and the Portfolio Strategy Team at 5 Plan Partners. Rolling 3, 2.
So, gentlemen, good morning.
Morning.
So, right now the conversation is: are we in a bear market? There's a lot of discussion about that. All our indicators are saying that we are in a bear market, correct?
Correct.
Now, just because you're in a bear market, can you have a recession?
Yeah, you don't have to. It doesn't always have to turn into one. You're going to, we'll see that. We'll be watching, but you can have the bear market, and that's kind of where we think we're standing.
Right.
So.
Right. So there's still a lot of volatility. The other thing is, and we want people to be educated about this, is that in bear markets, you can have some huge surges up. Is that correct? You brought up a point earlier this morning.
You see a lot of surges. It's usually due to short covering, which is what happens when people sell something they don't own. It's called going short. And to cover it, you have to buy it back. And so people are borrowing shares, using leverage typically to go short. And so if the market comes up in a bear market, you typically see it rise really quickly because people are having to cover those shorts, buy back at higher levels, and that's why you typically see the biggest rallies in Dow Jones industrial history are during bear markets. It's due to these short coverage. You saw anything that moves really quickly without a lot of fundamental reason. A lot of times it's typically short coverage. You saw that with oil last week, moving 20% in 2 days. That's a historically quick move. That typically is.
And it's already back down this morning.
Right.
Yeah. So on that, and then from the standpoint, a question I get is, Greg, if you think we're in a bear market and that we could see markets move down lower, then why don't I just sell everything? From the standpoint in terms of asset allocation, bonds at this point look attractive. We've got some great bond positions that could do well. Then also from the standpoint, you never know when the bear market's going to end. Is that correct?
Right. That's correct.
Yeah. So I think we need to make that clear on that. Ashley, you brought up about the R word, the recession word.
Yes.
Talk about that right now.
Yes, and Greg and Trey were talking about sort of bear market recession, and you don't have to have one without the other, and this is a case where we don't. If you look historically from the end of World War II, every recession that we've had basically has had three things in it. It's had a drop in industrial production, makes sense, had a drop in stock price / corporate profits, and it's had a leading drop of about 1% in the employment rate.
Right.
Well, the bottom line of it is employment's growing, so that's doing well. And secondly, the other research we were looking at over the weekend, if you extract this energy dynamic going on, mainly in mining and oil and gas, S&P corporate profits are good.
Right.
That's one sector has been down. Also, too, if you look at manufacturing output, same thing. If you look at the sector like mining and oil and gas, they're down, but everything else is doing fine. So when you hear the recession word more and more in the popular press, we're not there.
Right. And then from the standpoint also, though, we are in the middle of history. Saudi Arabia at this point has made it clear we are going to continue knocking that price down until we bankrupt the frackers.
Oh, right. They came in over the weekend and announced that not only are they not going to cut production, they're continuing to invest in more infrastructure to increase production.
Okay. All right. And so from a historical standpoint, this is a whole nother type of economic war. Agreed?
Yes. No,
I'll use that terminology. There are those that might disagree with me, but we're seeing that across the board. So, and the frackers are holding up pretty well in this country. Where else, and we talked about this earlier, where else are we seeing pain based on these oil prices?
You're seeing it in the countries a lot of times. Everyone thinks that Saudi Arabia is trying to just bankrupt our frackers, but countries can go bankrupt that are producing this oil.
Yeah.
You saw Russia, Venezuela, Brazil.
Right.
These countries are in not just recessions, some of them depressions.
Right. So I think Russia needs about $40 a barrel to actually even attempt to hang on.
Yeah.
And we're already much lower than that. So there's speculation that we could see Russia try to initiate some kind of war or conflict in the Mideast just to cause the price of oil to jump up. And the reason we talk about these things is because when it hits the news, it causes volatility in the markets, and in return, then it causes, as investors, concern about which direction is this thing going to go. Now, Bobby, one of the reasons the market went up last week was because there was a lot of generosity in Europe.
Yes.
As well as Bank of Japan,
Yes.
A few other places.
That's
Talk about
artificial growth.
Okay.
Central banks around the world come in and say they're going to, possibly add more quantitative easing, or that's artificial.
Right.
And so we've got another wild week in the markets ahead. A lot of information will be coming out.
Yeah, talk about that.
A lot of the companies are reporting earnings. Tomorrow we're looking at consumer confidence, and then also watching closely technology companies. Some big technology companies are reporting earnings tomorrow. On Tuesday. And then on Wednesday, another big day, we've got the Fed meeting to see what they say. Obviously,
that'll be crucial.
Depending on what, the Central Bank of Europe, Mario Draghi came out last week and said they have no limits. There are no limits to what they will do to keep their economy up.
Right.
And then Thursday, we have jobless claims.
Can I interrupt you on
sure.
that, though? From that standpoint, though, that got the hopes up
Right.
of people in this country that the Fed would go, you know what? Maybe we did tighten too fast.
Yeah.
Let's get more dovish. Let's get more generous. Let's go back to the way we were doing things. And I think that probably caused the market to jump up on Friday as well. The reality of it is we believe the Fed is not going to change its position at this point in time, correct?
Correct.
Or put another way, Bobby, is that we don't need to trust this artificial growth.
Right.
And another way I like to say it is that the United States is a patient that's been on medication. We've used this analogy before. And the patient is finally at a point, you can't give any more medication. Hey, Fed, doctor Fed, nurse Fed, however you want to classify it, we've gotten all the medication we can. It's now pretty much up to us to see to it that we make this happen. And so we, in some ways, are having a repricing in the market on different asset categories, or we're making adjustments in the market because we're coming off the medication. Is that fair? Would everybody agree with me on that?
Absolutely.
We're now into reality, and we need corporate America in this country, as well as leadership in this country, and others to come together and say, let's let everything take care of itself, and we don't need government to give us medication.
Right.
Correct.
Yeah, so that's important for those watching the vlog to understand. So
then on Thursday, we've got jobless claims. Now, jobless claims have actually been ticking up the past few weeks, and so we want to watch that carefully. Then durable good orders as well on Thursday. And then Friday, our GDP comes out. Now, expectations are for GDP to come in 1.5%, 2%, lower than it was at the middle of last year. And so watching that closely.
Yeah.
And what'll be one of the things we're watching closely with the GDP numbers is not just does it come in above or below expectations, but how does the market react to that?
Okay, talk about that. That's important.
To your point about the Fed, and last week the ECB came out, like Bobby had pointed out, very dovish, very, very supportive of quantitative easing. If GDP comes in negative or much worse than people expect, how does the market react to that? If the market reacts positive, that shows the market is expecting that the Fed will come in and help and save the day. That shows that we're back on bad news is good news and quantitative easing driving the market, not fundamentals, not really a healthy market. If GDP comes in low and the market goes down, that actually is for long-term positive because it's indicating that the market's not expecting the Fed to come in and save the day, and we could actually get a normal functioning economy.
Yeah.
So it's not necessarily really what the GDP data is; it's how we react to it that will be really important to watch.
Okay, and I think that the key word there is how or react. Mm-hmm. How do we react? How do we react to all the scenarios we've just talked about? How do we react in terms of this bear market? You as clients need to understand that in a bear market, it's about capital preservation. Yes. It's about there is a time to move to cash and there's a time to move out of cash. And so we look at that closely, as well as stay diversified in asset allocation to help offset some of the volatility that we see in the markets. So on that note, you can see it's going to be a very busy week, an eventful week, and we've got a few months ahead of us that aren't going to be dull either. And we're going to keep you updated. We want to keep information coming your way, and at the same time, we want to have dialogue with you. So have a great week, share this with others, and we'll look forward to talking to you soon. Thanks.
More information at fiplanpartners.com. Securities offered through LPL Financial, member FINRA, SIPC.